The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Daryl Martin.
And I got Lou from Fairfield, Connecticut. Man, how you doing, Lou?
I'm doing good, Daryl. And I got to tell you, you're not just blowing hot air out there. I think the way you look at the market is terrific. You're a nice guy as far as over the TV. All the research you do, all the homework you do, I truly appreciate it. I appreciate your view of the market. It's awesome.
I appreciate that. Thank you very much.
Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Daryl Martin.
Hi, folks. This is Basil Chapman, sitting in for Daryl Martin. I'm actually the host of the Tiger Technicians Hour, 11 o'clock till noon every market day, Eastern Time, that is. And, of course, the number to call in is 877-927-6648, same as always. And a couple of things that I should just mention, being the first trading day of the year, very often over the long weekend or whatever the time frame is, if it's just before or just after a weekend, normally it would be the first week of January that you get the big guns, the ones who run the funds. They're out right now, most of them. Or if they're in, it's just a very light, they're really not going to do very much. Whatever the trend is the trend. But if they're away, normally what they would say is to their underlings, hey, you steer the ship. Just make sure you don't hit any rocks through the Straits of Gibraltar, number one. Number two is, I want you just to maintain the same average as the S&P. If S&P right now is down 0.30, I don't want you to be minus 0.50. Minus 30 is okay, 0.30. If it's up 0.30, just follow the market. That's all. Just keep us okay. That's my thinking. I mean, there's no real proof on that. I'm sure we could get anecdotal evidence, but that's kind of what we've seen over the many, many years that we've looked at the markets. Okay, with that said, the price point is the price point. It doesn't matter what, does the pocketbook care whether it is January the 2nd or whether it's July the 20th, if you're making or losing? So we're going to look at it in a very pragmatic way. Most importantly, what I'm doing right now is I've just shown you the 10-minute chart. In the Chapman wave technique, you find the lowest, most obvious low. You merely count each successively higher peak until you get to a D. I use many other moving averages. In this case, you'll see the 10-minute chart of the E-minis, March E-minis. That's the 200-period moving average. Bam, it hits it, and it comes being repelled to the downside, and it plunges from a high of 2,067.25 to a low of 2,041.75. Now it's making another pattern that we're very familiar with. It's the arch formation, or the lowercase h. It looks just like an H. Look at this. It's got the back. It's a little sloped, of course, because you're talking about price movement that's measured horizontally. And there you go. So that's the H pattern. And as it stands right now, we're expecting that if the lower left side low bar of 2,041.75 is taken out, it better get right back in within one 10-minute bar above that low, or else it's going to close towards the lows of the day. That's number one. Number two is when we're looking at the 200-period moving average, the closer we can get to it, the greater the chance of it becoming a magnet line. That's going to take quite a bit of work. Now, another aspect here is that in the second H that's being formed right here, having not tested even that low over there of 2,043.75, that says if there was a rally in the next 10, 15 minutes and the rally went above 2,048, that would be very good action. You'd probably go a little higher than this peak right here of 2,051.25. So that's kind of how I look at markets. Now, let's get out of the way, because I promised in my show that we'll be looking at a number of different aspects. The first one I'm going to go to right now is the long term. Since we have now begun January, we can assess the 43-month move from 14,198 peak F in the Chapman wave, that doji candle in October of 2007, down to the March 64.69 low, back to the May 5th, the May 2011 high of 12,876. That took 43 months. Now we've got 43 months that concluded at midnight last night. No, it was midnight the night before, on the 31st. And that says that this trading session right now, in the monthly, has begun a move that until the Dow takes out 18,103, has to be called leg E with a potential peak E. And that'll be fairly significant because it is a time match, not a price match, because it extended over that high of 14,198 by quite a lot, by 4,000 points. And most importantly, what happens in the month of January is going to dictate a great deal about trading ranges, etc., for the rest of the year. So let's go through this. I'm just going to get right now on the shorter term. I'm just going to say that a Dow trading between 17,600 and 17,500 will set off alarm bells for me. I have been expecting that there would be a pullback here. Let me just go through my scenario. My scenario for my subscribers to my opening call states that we're anticipating that there's a move that should conclude later today or by Monday afternoon, Tuesday at the latest. And then we should have another rally that starts a peak A underneath that major peak A of 18,103 made on the 26th of December. And then a B. And then maybe by the time we break 18,103, you're already in C. One of the reasons being, and that's going to be the same thing for the S&P, that there's a buy mode underneath the major leg A. So far, this is what I call a single leg A syndrome. If it breaks below the 50% mark on the way down, that's just not a good sign at all. That's saying, hey, you better be really careful. I'm expecting, based on the weekly charts, and let's go to this, and I'm going to give you my summation, and then I'm going to go to other questions and callers. In the S&P, unless this is a match, and I just don't see how it can be because we've broken below the low that started the rally before over there, unless this is a match with 2007 with that rally that went to an A, an F, it was an E/A and an F/B in the weekly charts, in many of the weekly charts, and then collapsed for that 51 or whatever percent, it depends on the index you're looking at, collapse. This seems to me, with the stochastic still at 90% and the MACD holding very well, even though there's an M-shaped pattern, doing very nicely. The S&P has, in the weekly chart, it has right there, so it has 2,045 as the key support on the 9-period moving average, and we're at 2,051, down 7.82. The futures are down 8 to 25. The Dow is down 45. The QQQ series, or the comp index, is down 30. Gold is up just a little bit after being down quite sharply, about 14 or so points. That's pretty good action, but it's sustainability that's the issue with the gold, since the dollar DXY is soaring in leg D way above the 9-period exponential moving average. MACD looks good. This looks like, to me, it's going to go to an E, F, and maybe even a G in the weekly charts, and then you get a pretty darn good smash to the downside. Now, let me put that into the context of what I'm looking at here. This is leg C in the dollar. In the Chapman wave methodology, you look for at least Ds, right? So we should have more to go in the dollar. But here's my scenario, and I'm going to give it to you, and then we'll go back to the other questions, and I want to go straight to our caller. But let me just quickly do this. The Dow, to me, should be making some kind of a base and then struggle over a period of a few weeks to go to new recovery highs with a lot of resistance in the 18,200s, maybe 300s. I'm not expecting a breakout into the 19,000s, not yet. And then I'm anticipating a whopper of a move down. A whopper, when I'm saying a whopper, I mean double digits. Finally, we get the double digits down, and it just takes a lot of the favored indices down with it. That's number one. Number two is the volatility index. Oops, you know what? I'm going to do this. I'm going to go to our first caller, John in Philly, and we can go right to this question. right live instead of me making something up here that I'll have to repeat. John in Philly, how are you?
Good afternoon to you, Basil. Happy New Year to you.
Happy New Year to you, and a healthy one.
My goodness, we don't want to have to make stuff up. So here we are with my next question. I observed this. The Dow, of course, we've come off quite nicely the past 5 days, but the Dow has come back just a third of the most recent rally, and obviously we're very near all-time highs. Yet VIX has popped up quite substantially.
John, can I just interrupt you for 1 second? I'm going to ask you a question here. If I said to you, John, the volatility index has gone in the most recent pullback from the 14s to today's high of 20.14, where would you expect the Dow to be, even today, let alone over a period of 3 days? What would you say to me? Or the S&P?
Well, yes, to answer your question, I'd expect the Dow to be down 400, 500, 600 points. Of course, it's not. That's my question. And actually, so here's the question I've got for you. With the index so close to the highs and coming off, but so close to the highs, and
a couple of percent off the highs,
and the VIX popping up quite a lot. Now, what that's saying, of course, is that the cost of buying put options, protection on the downside, the cost has risen. And what that's saying is that the market makers, the people short selling the options, the put options, are raising the price of the puts that they'd be willing to sell at. And, of course, they hedge that out just to capture a spread and against a risk-free rate. So my question, given that VIX has jumped as much as it has and price has fallen as little as it has, my question, as you've seen that sort of phenomena in the past, does that tell you anything? That's the question.
Okay, that's a very good question. Now let me answer it in a couple of ways. I'm going to answer it very specifically, and you know that my answer, first of all, would be price is the arbiter of trend. I was speaking to someone last night who's a mathematician, and he was talking about the markets in kind of broad ways, but also very specific. He was asking very, very good questions. And one of the things that I'd said to him was exactly what I've just said to you, that price is the arbiter of trends, because very much like an MRI or an X-ray of the patient, if we're looking at technical analysis, it's as if you're looking at an X-ray of a patient who's just run a marathon and not feeling very good at all, and your assessment is that they're looking very good. And this will be for what we'll talk about when we get back after the break. Or you're looking at someone who comes in who's looking fantastic, and you do an MRI, and the technicals are very poor. How do you relate that to reality? I'll be right back with John in Philly.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzavento, Andy Hecht, Thinkorswim, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Daryl takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So we're discussing with John and Philly the volatility index, which is I treat it as a gauge of selling pressure and buying pressure, just to make it as simple as possible. I don't like the fear and greed aspect, although there is a fear factor that comes into it when there's a major spiral to the upside, which we might get here. I'm not sure if we're going to. But most of the time, I just like to think of it simply as if the volatility index is in the low teens to the single digits, that's buying pressure, and if it goes up into the 19s or 20s, that's selling pressure. That's buying pressure for the VIX, selling pressure for the market. I meant to add the other aspect. So the volatility index going up means that market is likely to go down, and vice versa. Now, what I just said, and this is very important to my way of thinking, is that if you look at, there are charts. I was going to grab one earlier on. I don't want to change things because I can move too quickly into another forum. It's not easy for me to do the baton passing over to another idea when I think it's the same idea. And other people, I remember from the talk the other night, there was a programmer who was sitting there, and he was writing and writing. And then every time I'd move to another subject, Hey, he didn't finish. Wait. So, hey, that's the way I think, and that's how I come up with ideas. As if I was a programmer, I probably would never have been able to come up with a Chapman wave methodology. So let me answer it this way, John. If you're looking at the patient, and the patient is looking fantastic, and you do an X-ray, and the patient says, hey, wait a minute, arteries are clogged, there's a whole bunch going on, I don't even know how he made it into the office. The reality is that that person, through genetic reasons, health, just physical fitness, whatever it is, can go on a lot longer than the technical deterioration. At some point, it is bound to catch up. So now let's put that into the context here. What has happened is that the stochastic in the weekly volatility index is basically flat at 27%. It is not skyrocketing as most of the other times it has when you've got this high volatility where it's spiked above the 200-period moving average. So that is one sign that says this is a move that is not really validated so far for me with key technicals. That's number one. Number two is it's nicely over the 9-period exponential moving average. That's good. Number three is it's way over the 200-period exponential moving average with a couple of hours to go, 3 hours, 2.5 hours to go before the close, 3.5 hours to go before the close, and as such, it says that 2.5 hours to go before the close. Sorry, and right now it has not closed above that 200-period moving average on a weekly basis for quite a while, and for the past since October, it's been showing tremendous volatility. Now comes the question, and this is really the question that goes to the exact direct issue involved. Why is the market not way lower? And my answer has to be is because I believe what we're looking at is insurance, because people are holding onto the stocks longer. They're trying to squeeze as much out of it. At the same time as being the first day of a new trading year, there are a lot of people now that are actually in the office and saying, hey, I want out. I held on because of capital gains or whatever it is to the very beginning of January, and I want to try to get out. Now, one of the things that I like to put together with this to answer your question is, how are other aspects doing? Well, the market has generally, up until now, been very much in favor of following the dollar, or the dollar has been following the market, but they've been working very well in tandem, and the dollar right now is in leg C at 91.04 in the daily, and the weekly chart is very strong in leg D, and the monthly chart is a breakout with a move above the 200-period exponential moving average, which is very much like a propeller shaft in that it suggests we could go a little bit higher towards the high 91s, maybe the low 92s, and maybe at that point we might have a problem. So I'm saying to myself, okay, how do you assess the volatility index right now screaming to the upside, and the day's young, so we're down minus 56 in the Dow, minus 8 in the S&P, and I must do the New York Stock Exchange because there's a direct relation. NYS. I shouldn't have said anything because while I was typing it, NYC, of course. NYA, if you don't mind, let me just get there, NYA.X, and that is at a peak A and pulling back sharply, but the New York Stock Exchange did not make an all-time high, and that's in the broader 1,800 or 2,000 stocks. So I have to put this together and say, I'm not going to make up stuff for the VIX and say, oh, it's just people are buying insurance. The reality is the VIX, in fact, is screaming, and the price is being affected. So now I'm going to ask you a question from your side, if you don't mind holding on, and we'll get to your question, okay? Be right back with John in Philly.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization optimization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Basil Chapman sitting in for Darryl Martin, and John unfortunately had to drop off, but John is in the den, and he's one of our wonderful denners with some fabulous setups of trades he always puts in. So it's just another fantastic enhancement of being in the den, and a benefit to many, many people. So I'll go on. So the VIX index right now, and this is going to be very interesting. Let me just show you a chart that I had. And then I want to do this just to explain what I'd be looking at. How can I find it? This is the 30-minute chart, and it's so interesting that the market right now is dropping further. It's as if the nervousness. There was an expectation that there would be a bounce after the big bounce and pullback. The bounce was kind of just a modest bounce. Then there was a retest and a lower low. And then there was another rally, and it looked like that rally would be that midday rally. But in fact, what's happened is, you see this, it's almost like a V-shaped pattern. I'm going to, for the moment, just call it an oval pattern in the 30-minute chart, just to explain something, that it's already gone to what would be a G. But in fact, that can recycle. And all you would need is, by the end of the day, to see 20.14 taken out. And I would have no choice but to call that a new leg B. So I'm going to be watching the close today very closely, and of course, Monday's opening. Why? Because it's going to impact Europe. This is the 200-period exponential moving average in the VIX index. Now, let me do a couple of things here. This is the VIX, which relates to the S&P, but most importantly, it's the close at 4 o'clock today, and so far it looks like it's going to close pretty much in at least the 19s, maybe it could be higher, or at least the 18s if even there's a pullback. But most importantly, I have to respect this, because my scenario has been, and now I have to put the VIX together with my scenario. My scenario has been that there would be a pullback in the Dow after this major leg A up, and at some point, somewhere, I didn't think the 17,600 to 17,500 Dow would be taken out. That's going to be really important. A close below 17,500 really sets up a completely different scenario. So I'm looking at this and saying somewhere in the 17,670 to 17,650, that would be the 9-period moving average support in the weekly chart. There has to be some kind of support, and then within that you're going to get a rally. I was anticipating that rally should take us to modest new highs in the Dow and the S&P into mid-January, maybe a little later than that. And then we get a 12 to more than that percentage pullback. Scary, because it starts to impact all the best movement, the hotels, all the groups that were absolutely fantastic up until now. And that worries the fund managers, because this is mostly what they're in. And they'd grab the IVB every time there was a pullback. They'd buy the biotechs. And that was the fantastic thing to do. However, at some point, the sell-off in 6 to 8 weeks stops, and then you get another rally, and that rally should take us to new all-time highs. That's my thinking at this particular point. Still is at this particular point. So with that, I want to just say that the volatility index cannot be ignored. There are two ways of looking at it. Either that it's a false move because it's made up of other factors rather than internal weakness, and therefore there's going to be a massive rally coming up from these lows. Massive meaning you get back the gains. It doesn't mean to say we go to 19,000. It just says a sharp turnaround to go to new recovery highs. Or it's the real thing, and it's just a heads up to say, hey, watch out, take me seriously. And I won't know until we close today and we start Monday and Tuesday. Then I can give a much better overall look at that. Now let's go to Jerry in Boston. We've got EBV you're looking at, right, Jerry?
Right. Remember I was saying that I'm looking for the rates to go down, the economy to soften early in the year?
Yes.
And the ISMs and the PMIs today showed downticks. So they've had a rally. So what I'm looking for is, I only have a little bit in what my major idea is, and I'm trying to an entry point in the EDV.
Okay, EDV, here we go, folks. ED is the Vanguard Extended Duration. Is this treated as a fund, or is this treated as just a stock?
It's like the 30-year bond. It's sort of an equivalent.
It's like a TLT?
It's the TLT on steroids.
Oh, okay, all right, good. Okay.
Because it's a longer maturity. Like last year, this was up 30%. The TLT was up like 22 or 23. So
isn't that interesting?
If I'm right that the rates are going to come down on the treasuries, this one will give you a bigger bang than the TLT.
Okay, so in other words, it's got a multiplying effect. That's number one. And number two is the chart pattern is very much like the TLT. The difference is in the percentage gains. Like right now, it's up 2.18, it's up 1.76%, and the TLT is up 1.10%. So that's the difference. Okay. So what we're looking at basically is bonds. If you don't mind, just for the moment, if I can go to the TLT, because that's the one I've done the most work on. So the TLT right now, it's in leg, and this is the whole thing about the Chapman wave. In the TLT, it made a high of 127.72, which is above the 127.68 high of the 15th of October. That was peak C. And then we had what I call an inside Chapman wave, overlapping wave, which takes you to a D in combination with the previous reactivated C. This is the way it's looking right now. And that normally would take you much higher. In this case, it made just a few cents higher to go to D at 127.72. That's 4 cents higher than the high that was made back in October. So now what it's saying is the pattern is changing somewhat, and it's now looking like a cup and a handle. Not one of my favorite patterns, but one that in IBB they talk about a lot. It's how you trade this. And basically you could trade this as long as it's still underneath the left side lip, because you're expecting that when it breaks out, and it breaks out quite sharply. My experience with the cup and handle is that in the cup and handle formation, you might break to the upside, but invariably you're going to come back into the body of at least the handle. So I'm looking at this, and what I need to say to you is that within my work, this is maybe a B, a leg B, a new leg B, but because it's at 127.66, if it goes to 127.73, immediately I will call it leg E/B. Why? Because a great deal is going to be dependent on the stochastic, which is only at 59%, and the MACD, which is now only crossing positive and could deflect lower. That's why I've been calling this a very important phase. Right at this particular time, not only do we have inflection points that could be working negatively and positively in certain stocks and stock sectors, but what we've got here is that bonds are moving higher with the dollar, and gold has just turned around and gone up. And it is rare that you get these three parties. I think they're each telling us something a little bit different. It might turn out to be the same in the end. So now what I'm going to say to you is, I think your assessment of bonds is correct. But at the same time, when we start to get to major highs on the left side, and the TLT has a major high at 132.22, I would say only 5 points away, but you know that in the bond market, 5 points can either be a lifetime or it can happen very quickly. It can either take forever to get there, or it can just suddenly spiral up. And
I'm thinking it's going to get there when we have this. I also strongly expect a pullback in mid to late January, and this is when this will kick off. So I'm looking for like a 2 to 3 month time horizon.
So it means, Jerry, that in a sense you've got to say to yourself, I have a particular, let's call it a template in mind, and therefore you've got to be very careful just to be aware that sometimes in getting from the concept to the objective, in this case would be to have higher bonds, lower yields, you might have a couple of little bumps along the way, and you have to be prepared for it. But as I'm looking at it, the monthly chart and the TLT has a stochastic at 82%. The MACD is very strong. It is way above the 9-period moving average. The Fibonacci ratios all suggest that because we've gone halfway into this retracement, the very last retracement, which is, I'm just trying to, if I move it, I might be making a mistake. Let me try. The 764 right there, and it's going to try for the 100% if the TLT is able to get above 128.35. That's about a point higher. My thinking is here that over a period of 3 or 4 months, somewhere within that time frame, we should have a test of that major high of 132.21. So now I've got to say to you, with that in mind, let me just say what you've got to be a little careful of. The wick that was made of the candle of the week of 17th of October going to the high of 127.68 was filled in very nicely, and we went slightly above to that leg D with a doji. The candle that's formed now in even a shorter time frame, now it's only taken 2 weeks, and this is the week that there's a chance it could go above 127.72, says that we're going to an acceleration mode. We're starting to accelerate towards the each new higher high. No. And that says by Friday of this week, if there is a close above 128.60, that's what you really want to look for here, Jerry, is not just a spike above and then a close below 127.72 on a week from next Friday. That's what I'm talking about. I keep forgetting. I keep thinking this is Monday. It's Friday. So next week, what you want to see is I'm not going to be happy here with a close this week below 127.72. It means that there's a chance you could pull back a little bit, especially if I'm wrong and the market's not going to have a rally. That'll say bonds could also be pulling back here and yields could go higher just in the shorter term. And that says just on a very shorter term basis, look out for support at 126.30 to 125.50 to 1, or the whole 125 should become very strong support in any pullback here in bonds. Otherwise, you've really got in the daily a double top formation, and that's what I was talking about, I think, in my show earlier on. So all I'm saying is be careful. There could be somewhat of a pullback here, but yes, I think the target, you're correct, that there will be lower yields.
Yeah, I'm actually hoping for a pullback because I'd like to buy more, in there. And I'm hoping if the market goes up next week, it's going to go a lot on data. A week from today is the employment report.
Oh.
If that's good, the rates might go up and this go down. But if that is disappointing, this damn thing could spike, up to 128.
Right, and as I say, we're right on the cusp, technically, of saying, hey, there's a little bit of a double top here. We could be pulling back, be a little bit careful. And at the same time, that's why I'm saying to you, I would like to see by next week a close in the height 128s or the 129 level, because that'll be a decisive breakout. It'll defy this cup formation that's forming now, the pattern I call the drop bucket. However, I'm going to pull this a little bit more and say to you, remember I was talking about the cup and handle pattern? So that's the one that we're looking at here in the daily TLT. And the right side, if I was to do this, which I often do, I go like this. I just grab that line, a vertical line, and I say the technicals were perfect going to the top on the 5th, that was the day of the 15th of October where the market reversed. Then it pulled back to 118. That's 7 points. That's a big move in bonds. Then it ran back up and squeaked to a new height, 127.72 in leg D. That leg D was an overlapping wave in the Chapman wave and should have been really much stronger. It wasn't. The technicals were not nearly as strong, and now they're even weaker. So I'm suspecting that bonds are saying, hey, we're getting a little bit tired. Next week's going to be very, very important. So, in a sense, I like your what you're looking at, and at the same time, I think that what's very important is that we have to take into consideration that this market, in the next 2 days, it's just going to give me a wealth of information. I mean, I'm looking at the portfolio I have for my subscribers. Our longs are doing well, even under this pressure. They're up. And the short that we have is dropping quite sharply, and the option has wow. The option, in fact, is up about 50, 40. No, about 50%.
You've been doing a good job. Yeah. Thank you. Thank you very much. I'm actually hoping that the bond goes down for a little bit. The price, because I want to buy more. So I'm hoping next week there's some good data and it goes down, because I'm in it for a 2 or 3 month thing, and I want to put more in at a little lower price.
Well,
but anyway, you've really helped me on the perspective on this, so I appreciate it. Okay,
because the scenario I just outlined you on a technical basis, the veracity is right there. Cup and handle, weekly chart, getting closer and closer. If it breaks out because it's speeding up, you want to see a decisive break. Shorter term, I think there's a bit of a pullback coming, and then I will call it leg E/B if we go to 127.73. And we have to just let the whole thing play out. Hey, good. It was good to see you the other night. And hey, you've traded this beautifully. Hope that keeps up.
Have a good New Year. Take care.
And same to you. Thanks for calling, Jerry. So, folks, let's do this here. I also had promised in the previous hour that I did for my show that we would look at the SMHs. The SMHs, the semiconductor holders, and what they are doing right now, they can't, not SNH, that's an interesting chart, SNH, SMH. And what we're looking at is that H pattern that I always talk about, is unfolding in the semiconductor index. Did I hear music? Oh, time flies when you're having fun. So let me do this. The estimations are down 48 cents at 54.40.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
Hi, folks, we're back, and okay, we got callers lined up. Let's go to Mohammed in California. Mohammed, how are you?
Hi, Basil. Happy New Year to you.
And a happy New Year and a healthy one to you.
Thank you. I was wondering if you could take a look at SYNA, SYNA. It took a beating today, dropped 6 points.
Are you? What position do you have?
Actually, I'm long.
Okay. Now, are you losing right now, or are you okay?
Yeah, actually, I'm losing.
Okay. Now, I'm gonna. Yeah, I like to just I like the idea of when you expect something and it turns out to do something else. It's almost an island reversal this morning. Sino, which is Interface Solutions for Entertainment and Electronics. Synoptics is the name of the company, SYNA, trading at 63.57, down 5.27. Don't just jump in and do exactly what I'm saying right now, but you asked my opinion. And my opinion is the pattern that I'm looking at in the monthly is the one that concerns me the most. It would have been great if instead of today's action, it was up. Instead of closing on Wednesday at 68.84 and now trading a little bit down 67 or preferably at 73, I would have said, whoa, that's nice action. Even though the technicals were starting to turn down, instead it's done the opposite. Please think about it. I'm going to suggest a way of dealing with it, and you might not like it, but you know that I'm just going to tell it to you as it is. Personally, I would exit the whole trade. I know that I can make up some money. I don't want to spend time making up a chunk of money. The way it looks is that even if it has a bounce, it's going to be retesting the 62 to 60 level at some point in the next week. I don't like that. So my suggestion is I would take something off right now as we're talking at 63.62. And then since you've already set out the day without doing anything, the low is 62.75. I wouldn't want to see it go below that. And I'm looking at the weekly, I'm looking at the monthly. I don't like this action at all. So if you don't mind, I'm going to say to you, I would take something off right now, and then I'd put a stop on at least part of the rest of the position under today's low. And if you want to hold a little bit, I'm inclined to just get out of a bad trade and think clearly and make it up over 2-3 weeks or months. It doesn't matter. I don't want it sitting on my head saying, oh, geez, I'm making money here, but the synaptics, it just keeps going down. So I'm just going to say to you, that's my attitude. I don't know if it helps you or not, but I wanted to just tell you, I don't like the look of it right now.
Thank you so much, Basil.
Okay, Mohammed, good luck with this. And don't jump in. Just think it through and then see what you can manage comfortably. And if you want to keep some, that's okay, but not much, because it has a lot of work to do to make up for today. Thanks for calling.
Thank you.
Thank you. Let's go to Dan in New Jersey. Dan, how are you? We've got a moment. We've got time for your question.
TVIX, where would you set a stop? I'm in at like 230.
So if you're in TVIX, which is 200% long, the VIX index, I would make it real simple. Let me just grab the 120-minute chart. A, B, C.
It looks like it's in leg E, right? Oh, I'm on a
120-minute chart?
I'm on an hourly.
Oh, on the A, B, it could be, and I've got it only in C in the 120-minute chart. Yeah, so I would do this. I'd make it real simple. It's acting very well right now. You've got a tremendous gain in it. I'm going to make a suggestion. I don't know if you like it or not, but I'm going to suggest take a tiny little bit off to reward yourself. Just a little bit off, and the rest, I would say 258. That's giving up a lot of percentage, but it's still pretty good. If we're going to continue down Sunday night into Monday, you want to be there. At the same time, I wouldn't want to mess around with a very nice gain. Take something off to reward yourself. Keep the core position, and that would have a stop on the very short term, 271. If you want to say, you know what, I'm going to hold it at 271, I'll take something off. But in the meantime, it's acting well for you. I would just say it's a highly volatile instrument. Try to take gains whenever you can. You can always put it back in. So take a little bit off, and 271 is one level of support. 258 is critical. A close under 258, 250 says, hey, this move is over, and now it's starting to
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, oil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. You're watching Tiger TV.